dapper as usual. Right now, though, let's get started with our roundtable. Jonathan Hoenig, founder of Capitalistpig hedge fund, Todd Schoenberger, managing partner and portfolio manager at LandColt Capital, and Martin LeClerc, principal and CIO and portfolio manager of Barrack Advisors. We got to shorten your title down a little bit there, Martin. All right, guys, this is what I want to do. People at home, they always come to me. They see me in the street, and the first thing they tell me, hey, I love you on TV, but I'm not in the market. I'm like, are you kidding me? And I'm looking at him. You know, the guy's got on an Under Armour shirt, Nikes. I mean, you're in the market. You're fueling the market, and it's nuts that you would go out and you would buy a pair of sneakers for $200 that would be obsolete one day, and don't think that you should be the owner of the company. You're a spokesperson for it. You're the consumer for it. For me, I was kind of thrusted into the market because of financial situation, our family. I was the oldest kid. We needed to make money. At a very young age, I equated the stock market with money. What I want to do with you guys is to find out what kind of motivated you initially to become interested in the markets. Let's start with you, Martin.
Well, I needed a job. And it was 1979. I was just getting out of college. And a whole generation of investors have been wiped out by the bear market.
And you weren't afraid?
I wasn't afraid
because... Or were
because...
you just too broke to be afraid?
Well, no, it was my reading of history. I figured, you know, cycles come and go, and the bear market that started in 1965 didn't end until 1982. So I got into the market at a very good time, 1979. The guys who were in my office in Washington, D.C. were one of the few people who survived the bear markets of the 70s. And so I was able to learn from them as to how they were able to survive. And the way they were able to survive was by putting things into common sense, to, as you mentioned, to consider yourself to be an owner. And that was first and foremost, yes.
Did anyone... Were there more encouragement or less, more discouragement? In other words, you know, for me, the only person who really thought it was worthwhile was my mother. You know, everyone else was like, oh, the market, forget about it, you know. How about for you? How was that?
Well, my dad thought I should get a real job, like become an engineer or something.
Hey, that ain't bad either. That ain't bad either. What about you, Todd?
Well, it happened back in 1982 when Ma Bell broke up. So my father, he was working for AT&T, and here he was given all the stock and all the regional Bell companies, but had no idea how to follow what he was actually investing in. So we learned it together. We actually looked at the stock tables, and at that young age, I started realizing the theory of compounded growth. You start thinking of equity ownership. It just was a little bit fixated about that. So really, at that early age, I started learning, and by then, it just being self-taught, actually ended up doing these crazy gopher-type jobs at Merrill Lynch, working in summers in high school. And from there,
But you felt, though, at some point... Go ahead, John.
And Charles, what's so interesting, Charles, is that, you know, young people are interested in money. They're interested in trade. They're interested in looking for the future. But unfortunately, I think our public schools don't teach these important lessons about exactly what the panel's talking about. Learning about money, learning about compound interest, learning about choices. You know, I got started, I was working at Starbucks and actually invested in Starbucks stock when I was making more money off the stock than I was off cleaning off coffee grounds off the floor. I knew this was something I was into it and built from there. But, you know, there's just a total lack of financial education that starts young, and it's no wonder that so many people even today are sitting out of the opportunities in the market.
And it has changed, though, too, Jonathan, to add to that, because if you start thinking about kids nowadays, they don't feel that mystique of wanting to work on Wall Street or work in finance, because you have to think of the crisis in 08, and then obviously leading up to today, you still have a lot of finger pointing, and we're still under the board.
I mean, in that regard, some of them don't think about working in general. I mean, listen, that's a different show, perhaps, but it is part of a greater challenge, I think. You know, Jonathan brings up a fantastic point. Even balancing a checkbook, that stuff isn't taught in schools. Certainly the idea, and by the way, it starts with young kids, but it goes all the way up. I mean, the people that I have these conversations with, Martin, I'm sure you must too, 40 years old, 45, 60 years old, wants to retire, wants to go mountain climbing, wants to go around the world, just doesn't have the cash, although they made enough throughout their lifetime. If they had invested it, they would have. But the public, the media, a lot of things conspire to scare them away.
Yeah, people overspend. That's a huge reason why people don't reach their financial independence.
When people tell you, and you tell them what you do for a living, you're at a cocktail party or a softball game, wherever, and they tell you they're afraid, what are some of the reasons they tell you they're afraid or intimidated?
I think it's just lack of knowledge. And I think you talk about how everything conspires against them. I think one of the things is short-termism, that people lose sight of the fact that what they're doing is they're owning a piece of a business. And ultimately, if that business does well over the long term, then you'll profit from that. But, 6 months or even sometimes 3 or 4 years is not enough time to have a great business show its true intrinsic value.
Todd, what about you? Because I know we're going to get to Jonathan, and he'll help us with the conspiracy theory side of it.
Yeah. Well, I mean, a couple of things here. One, you don't have the younger generation that does prefer to really learn about investing and really the power behind it. I mean, there's a great Google. If you just go to Google, key in 25 to 35 investing. If you are a 25-year-old and you invest $3,000 a year for 10 years, that's $30,000 at 8% interest. If you take that same person, if they didn't start till 35 and stopped at 65, that's 30 years of investing. It's $90,000. Yet the guy that went from 25 to 35 would have $300,000 more dollars.
But here's the thing, though, Jonathan. A lot of people are afraid of that. They don't think of how much they're going to make despite history. They think of the big crash, how much they're going to lose, that they're going to lose it all. That's what dominates their mindset, or that the game is rigged and there's no sense in even trying.
Yeah, I mean, Charles, they're thinking with their heart, unfortunately, instead of thinking with their head. And that's, of course, really what investment is all about. It's about independent and critical thinking about your money. And I think to the panel's point, looking long term, not being so short term oriented. Charles, I always joke that investing really should be called watching, because even those of us who are professional investors, most of the time is not spent buying and selling and out of securities, but it's actually watching the market, watching the economy, trying to get a sense of the bigger picture long term trends. And, the real money is not made by, buying it during Fox and Friends and selling it by the time we get to Cavuto at 3 in the afternoon. It's made through those long-term trends, whether it's in stocks, bonds, or even in the last 10 years, gold and commodities.
Right, but before I let you go, Jonathan, you would admit people, when they see the crashes, even like hiccups that we had last week, the flash freeze, those things really do seem to weigh on the public's mindset more so than the riches that could be made.
They do, Charles, but unfortunately they weigh on those who are too overly exposed to the market. J.P. Morgan had that wonderful line about selling down to the sleeping point. And if you're all in the market, yes, when you have a hiccup, you tend to be quite concerned. But if you've got a reasonable allocation, depending on your age, depending on your risk tolerance, you're able to ride out those bips and ups and downs, which will always come in a much more easier way.
All right, guys, let's leave it there. You were fantastic. I enjoyed learning that about you, Jonathan.